Okay, guys. So now that we've got this interest rate concept as a way to translate the value of money across different time periods, let's use it in two contexts. First, if you have money today and you want to move it into the future, you can use the interest rate to basically figure out what it's going to be worth in the future. And you can use that to figure out things like how much money you should save for retirement if you have a certain goal. Okay? Secondly, you can also kind of go the other way. Suppose you are considering an investment that's going to give you a flow of income over the next several years, but you have to put money down now to invest. This interest rate stuff can give you an idea about how much you should be willing to put down now to secure a stream of revenues. So first we'll go over the basic idea with the whiteboard, and then I'll show you how you can use something like Google Sheets to draw up and calculate this. You can hear my kids upstairs. All right, so suppose we've got, we're considering investing X dollars each year. And we've got an interest rate of R. Okay, so if this is our situation, what's it worth in the future? So if we're gonna invest every year, let's say for capital T years, the first dollar or the first X we invest is going to be invested for, is going to earn interest for T years. So to figure out what it's going to be worth at the end of T years, we multiply it by the interest rate raised to the power of T. Okay? Next year's investment is only going to earn interest for T minus 1 years. So we add to that, the value that we're going to get after T minus 1 years for that one. The year after that will be invested for T minus 2 years, and so on all the way down the line until we get to the last amount that we save, which is not invested for any amount of time. It doesn't earn interest. Okay? So if we're going to do that, we can do something in Sheets to basically figure out, we can automate this calculation. Okay? So I have X saved, an interest rate, and I need the number of years. Okay, so what I've done here is I've coded up a little thing to figure out how much money you would need to save each year at a certain interest rate to have given amount of money at retirement. So suppose you're age 20 and you're deciding how much to save. Okay, so what we've got here is this calculates how much your savings at this year will be worth in the year that you retire, which is I'm gonna assume here is 65. So look at this formula. Let's see what is saying here. So B1 is this here. So this is the amount you saved. It's being multiplied by 1 plus B2, which is this interest rate. And I've divided by 100 because this should be a 5% interest rate is 0.05. So this whole term is that 1 plus R here. The X is that B1. And then it's raised to the power of B3 minus A6. So B3 is the age of retirement when I want the money. And if I'm currently 20, then I have to subtract off. And so 65 minus 20 is 45 years that this stuff is going to earn interest. Okay? So what happens if we change this from, say, 0 to, say we save $1,000 a year? Well, $1,000 saved when you're 20 is going to earn interest for 45 years, and at the end of 45 years, that $1,000 will have been turned into about $9,000. Okay? The money that you saved in your 21st year is only earning interest for 44 years, so it's worth a little less, $8,600, and so on down the line. If we get all the way to the money you save at age 65, it doesn't earn any interest, it's just worth $1,000. And that's this last term X here. Okay? So if you this last column over here, savings at retirement, is just summing up all of the value of all the money you save over all your life. And you can see that if you save $1,000 a year at 5% interest, when you're 65, that will be worth $168,000. Not quite enough to retire on. Suppose you want to have $1 million to retire on. Well, if you save about $6,000 a year, you can see that that's enough to get you towards $1 million. What if you could invest at a higher interest rate, 7%? Well, now that $6,000 is worth about $1.8 million at the age of retirement. And if you just wanted $1 million, we could figure out how much you would roughly need to save to get it. And it looks like about $3,500 would get you pretty close to $1 million at 7% interest. So you can see the power of these interest rates is really strong. What if we weren't able to start saving at the age of 20? I always find these kind of things about the magic of compounding interest a little frustrating, because they say if you just save XYZ for 45 years, it makes a bunch of money. But I mean, I have debt still from student loans and stuff. And I think a lot of people are in the same position, so it's not really feasible to save even like positive amount of money net over 20 years. So what if you have to start later? So let's change this to, we're going to keep this at 65, but let's chop off all of the, we'll chop off this money down here and say that you're starting saving at, say, 36. Well, you can see that that really, reduces your income a lot. Okay, you're down to 330. If you want to get up to $1 million, let's see how much you have to save. Whoops. Let's change this to 10,000. So now you're looking at, if you can't start saving until you're 36, you're going to have to save a little more than $10,000 a year to get that $1 million at the age of 65. All right, so anyway, but you can use these things to automate it. There are also formulas you can use, but I think in the era of spreadsheets, this is pretty easy. What if you have to go the other way? What if you have the option to invest Y and then you earn X for T years? For example, suppose you're thinking of putting solar panels on your house, okay? Because then you're not going to have to pay for electricity ever again. But the solar panels cost, I don't know, $6,000, and they're going to save you $300 in electricity costs every year. Is that a good investment? Well, you do basically the same kind of thing. Now we have a stream of income, just like we had a stream of savings before, but we want to figure out what that income is worth in the present period. So we're going to save a little bit of money in the first year, and that'll just be worth, say, X. Then in the next year, we save a little bit of money, but we have to discount it by the interest rate, 1 plus R. And then in the year after that, we have to discount that twice. There you go. And the year after that, we discount it again up to, sorry, this should not be a T, this should be a 2. Third, all the way up to the savings in our last year are discounted T. What's the intuition behind this? This is saying that if you had the value X over 1 plus R raised to the power of T today, you would be able to take that money, invest it at the interest rate for T years, and have exactly the same amount X after T years. Okay? That's what the intuition is. But anyway, the whole point is this is the present value of this stream of savings. And so we basically say if that's greater than Y, it's a good investment because the present value of the money is higher than the cost of the investment. If it's less than Y, it's a bad investment because we could take the Y, the money that we're thinking of spending on this investment, we could invest it in the stock market and pay ourselves at least X and more than X every year with that revenue stream. So let's look at how we set that up in sheets. So here we've got, I'll change this to 0 to begin. We've got something with an interest rate of 5, an investment that's going to last 30 years, and let's look at what this formula is saying. Remember, before we were sort of taking income and multiplying it by the number of years that it's going to be earning interest. Now we're doing the reversed. We say, this is money that I'm going to save in the first year, or that this investment is going to give me a stream of income in the first year. And I'm dividing it by 1 plus the interest rate, that's B2, raised to the power of whatever the number of years is that I have to wait to get that money, okay? So if I could save, I gave the example of solar panels that'll save me $300 a year, and they cost $6,000. Well, this says that the present value of that investment is actually only $4,600. What that means is that if I had $4,600 and $4,611.74, I could take that money, invest it at 5%, and that would earn exactly enough money for me to pay myself $300 every year, okay? Which is the same thing I would be saving from this investment. And then at the end of the 30th year, this investment would be completely exhausted, okay? So this is a bad investment in this case. I have 6,000, and if I poured it into these solar panels, and all I cared about was saving money, if I wasn't doing it to sort of try to reduce carbon emissions or something, then it's just a bad investment. But notice that it depends on the interest rate. If I change the interest rate to 7, like before, so when we changed the interest rate to 7, it was good for saving. You earned more money. But here, when you're talking about investments, if you raise the interest rate, now the value of my investment has actually gone down. And that's easy to see if you look back at this formula. We're dividing by the interest rate. But the intuition is that at a higher interest rate, I don't even need as much money as I did before to pay myself $300 a year. If I now have $3,700, but I have access to a 7% interest rate, I can invest $3,700 and pay myself $300 a year, and at the end of 30 years, that fund will be exhausted. So that's the present value of it. Instead, if the interest rate is really low, say only 2, now this investment actually makes sense, okay? The interest rate is so low that if I took my $6,000, I don't earn very much from it, and investing it in solar panels to get $300 a year turns out to be a good investment in this case. So that's sort of the main point of this section. Interest rates have sort of these counterintuitive effects. If you're trying to evaluate the value of a stream of revenue, higher interest rates make the present value go down because you no longer need as much money today to basically give yourself an equal payoff as this other investment. If you're saving money for the future, higher interest rates are good because they mean you're going to have more money in the future. Thanks.